Lululemon Athletica Inc. is currently trading at 210.35 USD, up a staggering 23.34 points or 12.48% on the day. If you've been watching the tickers flash green on your screen this morning, you might be rubbing your eyes in disbelief. For the better part of 2025, the narrative surrounding Lululemon has been nothing short of a eulogy. The market had effectively decided that the golden age of athleisure was over, that the brand had lost its premium halo, and that we were witnessing the slow, painful decline of a retail giant. But right now, at this very second, the market is being forced to eat those words. A 12% intraday move for a company of this size is not just a volatility spike, it is a violent repricing of reality. The expectation was that Lululemon was becoming the next cautionary tale of retail, a victim of its own saturation and the aggressive rise of cooler, younger competitors. The reality, delivered just moments ago via their Q3 earnings print, is that while the North American consumer is indeed pulling back, the global growth engine is firing on cylinders that Wall Street completely underestimated. We need to talk about what is actually happening inside the order books right now. You are seeing a classic short squeeze combined with a rush of institutional value buying. For months, hedge funds have been piling into short positions, betting that the company's inability to defend its market share in the United States against Alo Yoga and Vuori would lead to a catastrophic earnings miss. When the news broke that revenue actually climbed 7% to $2.6 billion, and crucially that international sales exploded by 33%, the bears were caught offside. You can see the panic in the volume candles. This isn't just retail traders on Robinhood buying the dip. This is major institutional capitulation from the short side. The stock had been beaten down to levels we haven't seen in years, hovering near $160, and today's launch to $210 is a signal that the Lulu is dead trade is officially overcrowded and arguably wrong. Let's strip away the noise and look at the uncomfortable truth that fueled this morning's gap up. The expectation going into today was that the departure of CEO Calvin McDonald, which was also just announced, would be the final nail in the coffin, a sign of a sinking ship. Leadership transitions in retail are often messy, signaling internal conflict or a lack of direction. However, the market is interpreting this differently. Investors are viewing this leadership shakeup as a necessary pivot. The previous strategy of simply opening more stores and raising prices on leggings had hit a wall in the U.S., where comparable sales actually fell by 5%. That is a scary number, and in isolation, it would tank the stock. But the reality that exceeded expectations is the sheer power of the brand in China and the rest of the world. While American shoppers are fatigued, the Chinese consumer is treating Lululemon with the same reverence that was reserved for Apple stock in the early 2010s. That 33% jump in international revenue is the lifeline that justifies a valuation reset. When you look at the broader consumer discretionary sector in late 2025, it is a mess. We have tariffs squeezing margins, inflation lingering in services, and a general consumer pullback on goods. Yet Lululemon managed to beat earnings per share estimates, delivering $2.59 against a predicted $2.21. This tells us that despite the top-line pressure in America, the company is managing its expenses and protecting its profitability far better than its peers. This is the kind of operational discipline that attracts the algorithms behind Schwab Intelligent Portfolios and the wealth managers at Fidelity. They aren't looking for hyper-growth anymore. They're looking for stability and cash flow in a turbulent economy. Lululemon just proved it can generate cash even when its core market is shrinking, and that is a trait that commands a premium in this environment. However, we have to be honest about the United States. If you walk into a gym in New York or Los Angeles today, the visual landscape has shifted. 5 years ago, it was a sea of Lululemon logos. Today, you're just as likely to see the minimalist branding of Vuori or the street-style aesthetic of Alo Yoga. The market knows this. The decline in U.S. revenue is an admission that the brand heat has cooled. The company's recent product launches, like the breeze-through leggings earlier this year, faced quality control issues and customer backlash, which rarely happened during their peak years. This execution error rattled the faith of long-term holders who viewed Lululemon as an infallible manufacturer of premium goods. The fact that the stock is up 12% today doesn't erase these problems. It simply suggests that the punishment, the 50% drop in share price over the last year, was too severe relative to the actual damage. The competitive landscape is where the real battle is being fought, and it is brutal. You have companies like Alo Yoga creating a digital-first, celebrity-driven ecosystem that resonates with Gen Z in a way Lululemon is struggling to match. Alo isn't just selling yoga pants, they're selling a lifestyle of wellness and exclusivity that feels fresher than Lululemon's community hub model from 2015. Then you have Biore, which has masterfully captured the male consumer with a focus on comfort and versatility that directly threatens Lululemon's ABC pant dominance. For a long time, Lululemon had the men's market largely to itself in the premium sector, but that moat has dried up. Investors using platforms like SoFi Invest or Interactive Brokers have been rotating capital into whoever they think will win the next decade of athleisure, and for a while it looked like Lululemon was being left behind. Today's price action is a reminder that while the challengers are loud, the incumbent is massive. Lululemon's scale allows it to absorb mistakes that would kill a smaller brand. They have the supply chain infrastructure to pivot, and they have the balance sheet to buy back stock. $1 billion authorized, to be exact, which provides a floor under the stock price that Alo and Biore simply do not have. Let's dig deeper into the China story, because this is the single most important factor for the next 5 years of this stock. The 33% growth figure is not a fluke, it is structural. In Tier 1 and Tier 2 cities across China, Lululemon is positioning itself not just as gym wear, but as a status symbol for the upwardly mobile middle class. This is the exact playbook that Nike used to conquer the globe in the 1990s and 2000s. While North American malls are seeing lower foot traffic, Lululemon stores in Shanghai and Beijing are outperforming. The company is cautiously expanding its footprint there, ensuring they don't dilute the brand equity. For an investor, this geographical diversification is critical. It means that a recession in the U.S. doesn't automatically translate to a disaster for the stock, provided the Asian markets remain robust. This decoupling is what turned the sentiment around today. The market realized it was pricing Lululemon as a purely domestic retailer, when it is in fact a global powerhouse in the early innings of international expansion. Financially, the company is in a fascinating spot. The price-to-earnings ratio had compressed to roughly 12 or 13 times trailing earnings before today's pop. For a brand with B's margins and a clean balance sheet, that's bargain basement territory. It's the kind of valuation that makes value investors salivate. Even with the challenges, Lululemon boasts gross margins near 56%, which is enviable in the apparel world where most are fighting for 40%. This high margin profile gives them ammunition. It allows them to invest in R&D to fix their product stagnation, and it allows them to weather the tariff storm better than a company like Gap or Under Armour, which operate on razor-thin margins. When you're looking at your Fidelity brokerage account or considering where to allocate cash in your Roth IRA, these fundamental metrics, margins, cash flow, and valuation, often matter more than who has the coolest Instagram campaign this month. Now, I want to hear from you because the sentiment on this stock is incredibly polarized. Comment below how many shares of Lululemon you currently hold, or if you sold out during the slide earlier this year. Are you buying this rally, or do you think this is a dead cat bounce before it heads back to $160? I read every comment, and I want to know if you think the China growth story is enough to offset the American decline. Let's talk about the risks, because getting euphoric after a one-day pop is a great way to lose money. The biggest risk remains the fashion risk. Apparel is fickle. If Lululemon cannot reignite desire in the North American market, they will eventually hit a ceiling. You cannot grow internationally forever if your home base is crumbling. The new leadership team, whoever takes the permanent CEO role, needs to solve the product innovation crisis. They need a hit. They need the next Align pant. They need to figure out why their recent launches have felt flat. If they continue to rely on discounting to move inventory, and we've seen markdowns increase, they risk entering the Michael Kors cycle, where ubiquity and discounts destroy the brand's pricing power. Once you train a customer to wait for a sale, it is incredibly hard to retrain them to pay full price. This is the tightrope Lululemon is walking right now. Furthermore, the macroeconomic backdrop for late 2020